All right, in the last video, we looked at the MassMutual 10-pay product funded for 10 years and directly compared the old product with the guaranteed rate of 4% to the new product with the guaranteed rate of 2%, and we looked at both the guaranteed and non-guaranteed values. And we've got our cheat sheet here too. You want to keep in mind the 4% guarantee and the 2% guarantee, the different death benefits needed to get that $100,000 MEC limit. Minimize expenses, maximize cash value. Now, in this video, we're going to look at the same 10-pay product. We already looked at the 10-pay. We're going to look at a 10-pay, or I should say we already looked at the 10-year fund. Now we're going to look at a 7-year fund. Here's what I'm going to add about this, and this is somewhat specific to MassMutual's products. They're limited pay products. I've seen it with Mass. I have not seen it with other companies. Is when you take specifically their limited pay products and exercise what is called a reduced paid up option, which eliminates the premium prior to the end of the funding period. So this is a 10-pay, meaning I can pay into it for a maximum of 10 years. But if I go reduced paid up, let's say year 8, after I fund it for 7 years, I fund it up to the MEC limit, then chop the premium off. I cannot pay anything else into it after that fact. I have found that with MassMutual's products, their limited pay products, when you go reduced paid up, kick butt when you look at those internal rates of return and what things look like over time. And that's always been the case with the old product. Is it the case with the new product? That's the question. Well, let's take a look. So here is the 10-year fund we looked at. Let's do the same thing. So we tweaked this design a bit. It's still a pure 10-pay, but we did not use the same riders we used in the last example. Because it's just a flat 7-year fund, what we did was use a renewable term rider here. And one thing I want to mention is this gets a little funky because it is a level term rider that does have a level premium, or I should say the term rider has a level premium for 10 years, but based on the guarantees, the company actually reserves the right to increase that term cost each year for the term rider with this particular example, and that's why I see the premium jump up. Will that happen? No, I should say probably not. It never has, but just for the sake of a comparison, we want to make sure we illustrate it to keep the true guaranteed values net. Like we don't want to manipulate the numbers or anything like that. So there's our outlay. Because those numbers got funky based on the guarantees, I wanted to tally the total outlay. So with the added term cost, the plan was to pay in $100K for 7 years. It ended up being about $755. Break even point here between years 9 and 10. And this is with the guaranteed rate at 4%. This is the old product. Okay. Breaking even between 9 and 10. Not bad. As we look at the new one, same thing with the funky outlay, but look at this. We topped out at about $729,000, not $750. Here's why. Lower death benefit. It's about $1.5 million because we don't need as much based on the new MEC limits. I'm going to make this a click bigger here. That's better. So, again, that low death benefit means we need what? A lesser term rider. The base premium on both of these examples are exactly the same. We have a $10,000 base premium and a $10,000 base premium. Because the required death benefit for the 100K MEC limit is less on this example, we need a lower term rider, a lesser term rider, which has a lower cost naturally. That's why even when it increases based on the guarantees, it's not as high. But with that said, what's your guaranteed rate? 2% in this example. How about this guy? Breaking even year 12. Old one broke even between years 9 and 10. As we look at your IRRs over time, we don't even have to look at that. This guy, what do you notice? There's the cash value difference. So what this specifically means is this is how much money you have greater than or less than the old product. So by year 10, 50 years old, this individual has $60,000 less based on the guarantees in the new product compared to the old product, if that makes sense. Now, let's take a look at this as time passes. What do you notice here? Let's look at age 60. Old product, IRR, 2% average, over 3% on the annual return. Cash value is over $1 million. New product now, cash value is $835. Average IRR is 0.81%, $221,000 less in cash value. So if you really like the strong guarantees, even though the company and product has always done better than that, if you just like that for peace of mind, saying, hey, I just like seeing the stronger guarantees there, that's where it makes sense. That's where it would make sense to take that product out before 2022 while you can still lock it in. Now with that said, when 2022 gets here, there will still be products available with a 3.75% guarantee. Now we're at a 4% guarantee. Not much of a difference in that respect. And when that information becomes available, we'll be sure to go through it as well. But let's look at the non-guarantees now, because when I mentioned the product kicks butt with that reduced paid up option, this is exactly what I'm talking about. So this is based on a 6% dividend, same 10-pay product we looked at in the 10-year example, and the new product looked stronger than the old one based on the non-guarantees, dividend values. What is the case here? Year one, what do you notice? Old product has what in cash value? 88% right off the bat, 100,000 in, MEC limit, 100,000, about a negative 12% hit or a 12% hit on the IRR. Break even on the old product, year 5. I've paid in 500, I have 502. Next year, you pay in 100,000. It grows from 502 to 619. That means you got your 100 back plus another $17,000 on top of it, which comes out to an IRR of 2.82%. That's the net growth you saw that particular year. Time passes, here's what reduced paid up has done on their limited pay products. Average IRR gets up there. Look at this. Do you hit 5%? You do on the average IRR as time passes. Takes about 30 years, but that's strong, very strong. What do you notice on the new one? Is that the case? Still very strong. Stronger up front. Breaking even, I made it year 4 because I've paid in 400. I've got 399 and change at that point in time. I'm like, close enough, let's just highlight it. Year 5, I pay in 100. It grows from 399 to 514 and change. That's $15,000 worth of growth. IRR that year, just south of 3%. That's solid for a safe, liquid, tax-free area to position money. What I have noticed consistently with the major mutual companies is when the product is designed really with a minimum premium, maximum PUA allocation, we see the actual performance perform either spot on or very, very closely with the illustration. Why it would not be spot on is year to year, the dividend rate adjusts and there's insurance expenses in there as well. But my point is that original illustration, by the time I hit the second, third, fourth year, so on and so on, that dividend rate comes down. But of course we track it and we have studies where we've looked at actual performance over time. My point is we'll continue to do that with this change. So obviously it is more dividend sensitive, the new products, because here you've got a 2% guarantee and then a 4% surplus rate, which gives you the total 6% dividend interest rate in this particular example. And we've got other videos that really go into detail. If I went through that too fast, please reach out to us anytime and we can go through it thoroughly with you. Either I will or our team will. But here, 700 in, by year 7, you've got 760. Nothing in thereafter. Continues to grow. IRR. We do not see that big jump like we did over here. As time passes, what do you notice? Look at the far right in red. What this represents is the cash value difference between the new one and old one. So if we see negative $250,000, what that represents is at this point in time, is at age 64, we have $253,000 less in the new product than what we do in the old product. And that's with the reduced paid up option. So this is a unique situation too. And that's why on the top we've got no same, there's no similar case, or every situation is unique. I can't talk, it's getting too late this evening. But anyway, my point is if I'm in a position where I say, hey, I've got a lump sum of money, I'm attracted to the idea of max funding a policy and then going reduced paid up because that maximizes my internal rate of return, that's where this 10-pay product with this particular design can make sense. What I will add though, is this is a product with the riders we used with this particular company, MassMutual, we did not use their LISR rider, which is critical for optimizing flexibility. We have a renewable term rider. We don't go with this design that much because if life happens, I restrict myself from a flexibility standpoint to bounce payments up and down. This would work great for someone that has the funds in cash already. Otherwise, they might consider a different design. But that's the kind of stuff we want to talk through to make sure that everything's set up properly. Like there's all these little differences, but that's really what I'm a nerd about and our company likes digging into to make sure people are set up properly. So I hope you enjoyed this one. I had a ton of fun with it. What I really find so interesting, and I always have found this to be the case, is we just took with this video and the last, a 10-year funding option and a 7-year funding option with the exact same product, same company, everything's the same, but by making a pivot and from asking questions to the individual that's going to open the policy to identify which one's a better fit, we can determine, hey, they want to maximize IRR, make sure we show that. They say, you know what? I like the higher IRR, but I want to get $1 million into this and I want to keep funding it beyond 7 years. That's where the 10-pay. The pure 10-year funding could make sense. My point is, it's options. And we also got to see a little bit on the guarantees and the true difference between the guaranteed rate of 4% and the guaranteed rate of 2%. Hope you enjoyed this one. If you enjoyed it, please hit the like button, subscribe for more, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.